Chat with Traders, episode 120, is sponsored by our friends at TradeStation, a trusted online brokerage geared towards active traders. And as I'm sure you appreciate a good deal, TradeStation now offer new clients a simplified pricing plan. $5 stock trades, no software fees, free real-time data, and free scanning tools, amongst other things too. To learn more and open an account, visit tradestation.com/traders.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
What's going on, traders? Welcome to episode 120. Thank you very much for being here. I'm glad you could join me. First up, I must give a quick reminder. I'm hosting a small Chat with Traders event in New York on the 2nd of May. There will be beers, there will be pizza, and I'll be doing a live interview with a trader, essentially like a live podcast. There will also be a number of past guests of Chat with Traders attending, so it'll be a cool opportunity to meet with some of them, and more importantly, meet up with other traders who are doing similar things and who have similar goals to yourself. It's only $12 for a ticket, and that includes absolutely everything. You can grab a ticket at chatwithtraders.com/NY. Just so you know, since I first announced this last week, more than 80 people have reserved their spot already, and I have a hard stop at 120 people. So please be quick if you'd like to come. And a special thanks to Trading Technologies and Sanglucci, who are both sponsoring this event and essentially making the whole thing possible. Avoid the FOMO, reserve your spot at chatwithtraders.com/NY. Now, on to my guest for this episode. My guest is Meb Faber. Meb is the founder and CIO at Cambria Investment Management, where he manages Cambria's ETFs, separate accounts, and private investment funds. He's also authored numerous white papers and 5 books now. Meb's a budding podcaster too. His podcast is called the Meb Faber Show. The main reason why I asked Meb to come on the podcast was to talk to us about some simple ways that active traders can capitalize on the opportunity and compounding effect that somewhat passive longer-term investing has to offer. So I asked Meb about where to start out, how to set expectations, various types of portfolios, when to enter the market, what to do during drawdown, what things new investors struggle with most, and so on and so forth. Throughout the interview, Meb does mention a fair few links and resources. I've curated all of these at chatwithtraders.com/120, so you can find everything there. I don't think I've missed any. And one last thing, in case we have some new listeners here, please keep in mind you're 100% responsible for your own trading and investing decisions. Now, please welcome Meb Faber joining us from California. When you first got into markets, Meb, where did you start out?
So my background's a little different. I was a biotech and engineering student at university, but this was during the late 90s. So a pretty exciting time in markets, both for internet as well as biotech. If you remember back sequencing the genome and all the fun stuff going on with genetics. And so, I spent a fair amount of my spare time investing and studying markets. And so had actually started out as a biotech equity analyst, taking a year off before going back to get my PhD. But that 1 year off certainly became 2, 3, 4, and started gravitating more and more towards the quant side of the business before eventually starting Cambria in 2007 here in Los Angeles with my partner, Eric Richardson. But if you wanted to go back really far, it's certainly with my father, chatting stocks and investments in business, for many years growing up. And I even found a postcard the other day that I had written from camp that was talking about how I thought it was a good idea for us to pick up some shares at Disney. So kind of a fun reminder at an early age. But yeah, it was instilled pretty early on.
And so what other roles have you had? Obviously, you I think it's CIO and also co-founder of Cambria now. But what other roles have you had sort of leading up to that point? And I think you worked as a trader at some point also.
Yeah, I mean, so that it was started out as biotech analyst while I was going to grad school. And so that was focused on pure fundamental research, picking biotech stocks. And then it became a little more quantitative. I went to go work for a CTA, so commodity trading advisor, that I spent more of my time on trading systems, quantitative ideas, everything from very short term to very long term, but with a particular interest in what a lot of CTAs do, of course, which is a lot of what we do at Cambria, which is trend following concepts, long term trend following ideas that have been around for, of course, many decades. But and then had simply moved to LA in 2006 and started Cambria in 2007. And so, but it's a full spectrum from fundamental, technical, and then multi-assets from everything around the world, stocks, bonds, real estate, commodities, everything in between.
Well, tell us a little bit more about that. Like, how do you spend your time these days? What sort of things are you doing? What do you do now? What is Cambria, essentially?
You know, I think a lot of professional investors that are listening to this will sympathize, or this next comment will resonate a little bit, is that you learn pretty quickly the difference between managing money and the business of money management. And what I mean by that is, you know, simply coming up with trading ideas and systems and theory and research is totally different than running a investment business. And so there's a lot of people that are attracted to our world by, you know, of course, the money and the compensation, but also the really exciting, complex puzzles that exist in the world economy and investing. But, you know, also on the flip side of, you know, spending all day on chatting with lawyers and the SEC and managing public funds and talking to reporters and all that good stuff that goes in with running a company and making sure people get paid on time. So what do I spend most of my time? I enjoy doing is certainly the research and something that's a bit of a surprise had you told me 10 years ago when we started the firm is of course writing. You know, the first academic paper I ever wrote was an accident and published. And then looking back on it, it's kind of crazy now because we've published about a dozen white papers, 5 books, and I think the blog has going on 2,000 articles, which is a little crazy. So, but the writing has become part of the process. And so like you know, we started a podcast last summer, which has been a lot of fun. So the day-to-day is kind of coming up with ideas or concepts to refine our process or to help implement or improve what we're doing. And in some cases, you know, we have 8 public funds out there to actually launch new products or things that we look around and say, hey, I think this is a better mousetrap or a more interesting thing that doesn't exist that should. But the day-to-day that I would spend most of the time, what I like doing is reading and writing and skiing if I get the chance to. But this year's been a little light on the latter front.
Nice. Well, I mean, it sounds as though you've got a lot of things going on. I'm just interested to know, is there like how would you categorize your style or styles of investing and trading? I mean, is it possible to categorize what you do because you do so many different things? Or is there is there an overarching theme to what you do?
There's a couple. So when we think of launching funds or any sort of money management that we offer to the public, is that there's a couple criteria. And we say, look, number one, does this concept or fund exist already? Because there's plenty of fund companies out there like Vanguard, you know, multi-trillion in assets that provide a lot of products and they do it very, very well. 2, is it something that we think we can improve upon or that doesn't exist or that we can do cheaper? And we think there's still a lot of ideas out there that don't exist in the format that we think that they should. And lastly, for me, is it something that I want to put my own money into? And so unlike the vast majority of mutual fund managers, I think the number is something like ranges from 50 to 80% of mutual fund managers in the U.S. have $0 invested in their own funds, and on the higher percentages is less than 100,000. So, I have 100% of my net worth in our funds and strategies, and most of the people here do. So, is it something that you believe in and you want to invest in? And so, once you've said that, the funds are very different. Each one or each strategy ranges from funds that are very niche, that may say be a sovereign high yield bond fund. That's a very niche strategy, to something very broad, like an asset allocation fund that owns 30,000 securities around the world and is a super low fee. Now, that having been said, and everything we do is rules-based and quantitative, which we think is important to remove the emotions out of the whole process. That having been said, there are two themes that kind of have their tentacles in almost every fund or thought process. And it's two concepts that have been around for over 100 years, ever since Charles Dow was talking about it with Dow theory and trend following. So that's one, is in their close cousins, but momentum and trend. And then two is, again, over 100 years old, is Ben Graham talking about it. And that, of course, is value investing. And so some funds are pure value funds. Some funds are pure trend following funds. Some funds do actually the combination of the two, which is, if you had to pick one investment strategy or concept in the world that is the perfect synergy of everything I look for, it's value and trend or momentum. So basically something that's really cheap that's going up. But depending on the fund or strategy, those are the two main themes. And then, of course, we could talk about this at some point, but also the question of how does an investor holistically put together all these ideas into a portfolio and not go totally crazy with holding these two different ideas in their head.
Yeah, we're certainly going to get into that. I think that's going to sort of be the main focus of our conversation here. But I just want to go back to that stat you threw out. Something like 50 to 80% of asset managers don't actually have any money in their own funds. That seems really crazy. I'm kind of shocked by that.
Here's the funny part about it, and I know Nassim Taleb's got a new book coming out on this topic, which I look forward to, but it's either really strange and surprising or it's incredibly unsurprising. And so let's say the average mutual fund manager charges 1.25%. Average ETF is like 0.55%. In many funds, you can now get ETFs and mutual funds publicly for even like 10, 20 basis points. So in many cases, a lot of these mutual fund managers say, look, I know this fund is tax inefficient. I know that it's expensive. Why would I invest my own money in that? And that's a totally rational decision. Now, from the in-fund investor, it's the last thing I want to see. I want to see that fund manager investing in their own fund. And this is one of the reasons the hedge fund space traditionally at least has that going for it. The traditional hedge fund fee structure is much higher, but at least most of these managers have a lot more skin in the game, for better or for worse. But, and it depends on the fund too and the different strategies, but Morningstar puts out a lot of research on this topic, which is where we sourced it. And I can't remember the exact name of the blog post, but I can certainly send it to you, that has the charts on this topic. But yeah, it ranges depending on the type of fund. But in some cases, yeah, it's as high as 80. I think 80% have either nothing or less than 100,000 in the fund.
Right. Very interesting. Yeah, we might try and dig up that link, and I'll put it in the show notes if anyone's interested to read up more about that. But as we hinted, Meb, obviously I reached out to you, and you're aware of this. One of the reasons why I was really keen to bring you on the podcast is because I kind of want to speak to you about how active traders who trade very short time frames, either intraday or swing trading, holding positions for a couple of days, how short-term active traders can sort of tap into the opportunity of longer-term, bigger picture investing as well. Something that requires less input than it does to be an active day trader, for example. But something that is reasonably simple, reasonably robust, just some actionable tips and ideas for how we can sort of take advantage of that, the compounding effect. So I guess, on this point of conversation, what is a good starting point? I mean, let's just start right there. I mean, most of my questions, just so you know, are going to be fairly basic, but because I think this is quite new to a lot of people. People who are even advanced traders, I think some of them tend to neglect the investing side. Obviously, that's why I brought you on here. So what's a good starting point? Hopefully that made sense.
No, it does. And I think it's one of the most important things an investor can do. And so people, and it doesn't just matter if it's with investing or relationships or work, one of the most important things people can do in life is understand expectations. And so I saw a recent survey recently asked a bunch of investors around the world, what do you expect stocks to return? And same thing in the US, and of course asked some millennials too. And I think the average response is they expect stocks to return 10.5% or something going forward. And there's a couple comments on that. And so one is to say, all right, the first thing we need to do is set our base case and understand, what does history look like? What are the worst case scenarios? What are the best case scenarios? So my favorite investing book, which I highly recommend, it's expensive, so go get it at the library if you're listening. It's called Triumph of the Optimist. It's written by a couple of British professors. And it takes a look at the history of markets going back to 1900. And there's been some other variants of this. Ibbotson's done it. But this one in particular looks at about 20 global markets. So it looks at, say, for example, here's what the world looked like in 1900, and the sector composition and the global composition of markets. And then here's how these markets did since 1900. And here's an example. I mean, by the way, if you Google Global Investment Returns Yearbook, Credit Suisse does an annual update to this book that's free. So you can probably get about 10 years of this for free. That is probably the best investment writing that you can read. Highly recommend it. Anyway, so what's the historical results look like? So U.S. has done about 10% a year in stocks going back to 1900. And then if you look at bonds, they've done about 7%. And I think bills had done about 6%. So going back to 1900. Sorry, that might be a little bit too high. But the real return, so net of inflation, is that stocks did 6.5%, bonds did around 2%, and bills did around 1%. So you lop off that 4% inflation, and you get down to those numbers. Now, the U.S. was one of the best performing stock markets in the world over that period. It went from kind of this emerging market to now the global superpower. The best performing stock market in the world, I think, was tiny South Africa. And then the worst performing is Austria, basically had zero returns over the entire period, real, so after inflation. And that's not really the worst case scenario. The worst case scenario is China and Russia shutting down their capital markets completely. So essentially your investment there went to zero when the government said, thank you very much, we're going to take your investments away. So that's the base case scenario. And so we like to call it the 5-2-1 rule, meaning after inflation, stocks globally have done about 5% a year, bonds, and I'm rounding up, about 2% a year, and bills around 1%. And so every deviation from that, you got to start with that as the starting point. And you say, okay, U.S. stocks, they've also declined by 50% multiple times. So most people are familiar with that, global financial crisis, dot-com bust, but they also declined over 80% in the Great Depression. And Charlie Munger and Warren Buffett often say this, as many others. They say, look, if you're not willing to invest in stocks and experience quoted securities having a 50% decline, you shouldn't be in stocks in the first place. So that's a lot of just kind of, here's the base case scenario. So you should never be surprised if you buy a stock market, for example, and it goes down 80% or 50%. Now, you can come up with probabilities and projected outcomes based on a lot of other things we'll talk about, I'm sure, at some point, like valuation. But in general, you have to assume that potential outcome. And then so people say, okay, well, stocks sound pretty risky, even though they have higher returns. What about bonds? Well, bonds suffer from a much different risk, which is usually not the price crash risk, but it's really the long eroding effects of inflation. So while bonds on a nominal level have only declined by about 20%, bonds after inflation in the US in particular, but other places around the world, have declined by half. So in many ways, bonds are equally as risky as stocks, but it's a different risk, which is inflation, whereas stocks typically it's more of a manic depressive Mr. Market risk and the price change. So the solution for many people, first thing they do is they say, okay, well, I'm going to diversify across US stocks and bonds. We'll do a traditional 60-40 portfolio, and you get a little bit lower return than stocks, but you get lower volatility and drawdowns. Well, the problem with that portfolio is it's the volatility of stocks still dominates the portfolio. And so you have a portfolio that still ends up with very high drawdowns. We're talking 2/3 at some point. You can't really find a global market that hasn't had 2/3 drawdown at some point in a 60-40 traditional institutional allocation. And most investors, if you were to tell them, man, here's your basic moderate portfolio, 60-40, and you're going to lose 60% at some point, that's way too much risk for them. And it's really hard. And that's why you see so much bad behavior by investors when markets do poorly. And there's a lot of research that comes out that shows this, that people over and over again, based on their emotions, will sell at market bottoms, buy at market tops, rinse, repeat. And part of that's just because we're human. We're not really built to trade shares of IBM and wheat futures, but really the flight response and the greed takeover. And it's just part of knowing the history, at least, of what's capable and what's happened in the past can at least help you just take a step back and say, okay, let me implement some sort of rules-based policy portfolio or process to avoid me acting like an idiot going forward.
Okay, now when you talk about, just for example, stocks have returned X amount over, the last 100 years or whatever, when you say stocks have returned, are you talking about, the stock market index?
Yeah, so we're talking about like what we call a market cap weighted index, which means in the US, the good example is S&P 500. And this is actually a good talking point where the market cap weighted index, which weights, so the S&P 500 means you put the most in Apple and the next in whatever it is, Walmart, Exxon, et cetera. You put the most in the biggest stocks all the way down. And that reflects the market. That is literally the market. If you were to go out and just buy, quote, the market, that is the sum average of what everyone's going to have. Well, there's a couple comments on this. So one, a lot of people don't know this, particularly in the US, and this is a point of bad behavior also, is that, so if you look globally, the US is about half of world market cap. And so that means the rest of the world makes up the other half. And the problem in the US, for example, is that most investors in the US invest around 70% of their equity allocation in the US. And that's called home country bias, meaning they put way more in their own market than other markets. And it's a normal thing for people to do. It's the same reason I cheer for the Denver Broncos and I like skiing, is that, all these other things, is that it's comfortable. It's what I'm used to. It makes sense. But the irony is that it happens in every country around the world. So Aussies just as bad, Brits just as bad, Japan and China even worse, where these markets, people in the local country place way too much in their own market relative to the world percentage. And that gives you a massive uncompensated risk, which is this concentration risk. And you could ask anybody in Greece or Brazil or Russia the last few years in these countries that have declined 60 to 90%. And I'd say that was probably a really dumb thing to do, but it also applies to stocks. A lot of people, say, for example, may work at a company and invest in the stock of the company in their retirement plan. And so they're really like triple leveraged to the company, one with their job, one with the money going into their retirement plan, and three to the broad market as well. So that sort of risk and that sort of concentration, while market cap investing is the market, it's also a very suboptimal way to invest. And we can get into that if you want. But, a lot of people, to further clarify what market cap investing means, is a lot of people will say, hey, look, the S&P 500, what's that? And I'll talk to friends and they'll say, well, it's the 500 largest companies in the US. I say, right. Largest by what measure? And usually my friends will say, well, probably like earnings and revenue. I say, no. The only measure that matters is simply the price of the stock times the shares outstanding. And that's what we call, that's market cap. That's how big the company is. But it actually has nothing to do with whether the company makes any money, whether they ever sold one widget ever, whether they have any revenue, anything, whether it's a good value, whether the stock's super cheap or inexpensive. All it is how much are people willing to pay for the price of that stock. And so if you were an alien and came down and said, is this a reasonable way to invest? I don't think anyone would think it is, but that's the market cap investing. Now, the pro of that is that by owning the index, and this is one reason why it works historically, is you're guaranteed to own the winners. So you're guaranteed to own Apple, Amazon, McDonald's, all these stocks that have had incredible performance. And the historical results show that it's actually a subset of all of the stocks out there, maybe 20%, that deliver all the gains. So market cap investing is a good first step, but it's not an ideal way to invest.
Okay, team, it's that time for a shout out to TradeStation, a really great supporter of Chat with Traders podcast. As a TradeStation client, you're going to reap all the benefits that could be expected from any online brokerage, but many extras too. Just to give you one example of this, TradeStation's trading platform and analysis tools, while having powerful capabilities, are clearly built to serve the real-life needs of active traders. While something like this may sound kind of obvious, it's surprisingly hard to come by. Layer these benefits with TradeStation's simple pricing plan, and you've got yourself an all-in-one brokerage and technology solution that's tough to beat. Learn more about TradeStation, $5 stock trades, no fees, free scanning tools, and more at tradestation.com/traders. At this link, you'll also find instructions on how to open an account. Once more, the link to visit is tradestation.com/traders. Now, just before we go any further, obviously I kind of outlined my reasons for wanting to bring you onto the podcast here. And I just want to go back to that a little bit. Is it slightly naive to think that you can do well in investing with, what's the right word, with limited input? You know what I mean? Because like I said, one of the reasons was obviously active trading is very time intensive. I kind of see longer term investing as something that does require less input. I'm just curious to get your opinion on that. Like, is that me being naive? Because if someone said they wanted to be a trader with very little time input, good luck. Is it the same with bigger picture investing? Obviously, it takes up a large part of your day, but you're doing, many things. As someone who wants to take more of a passive approach, is that reasonable?
So here's the beauty is we wrote an article a couple of years ago, I think, called "It's a Wonderful Time to Be an Investor." It's probably the best time to be an investor in the history of investing as far as access to low cost portfolios. And what I mean by that is any investor could go out and buy a handful of Vanguard funds. They could buy our asset allocation ETF, and boom, in one shot. And there's even brokerages that don't charge commissions at this point. There's the advent of all of these digital advisors that now do it for you. So it's very simple, and you could just go sign up for any of these digital advisors. We have one, Vanguard has one, Schwab has one, but you could also just go buy all-in-one fund, and meaning you get all of these things for a super low cost and a very, very tax-efficient vehicle. And that's awesome. You go back 20, 30 years when these brokerages would charge 3%, or even 10 years ago. And the scary thing is that a lot of this still exists in the world. So the flip side of this is that you've never had more access to dynamite to blow yourself up as well. The ability to have an app on your phone, and you can trade all day long and not pay commissions and, check your balance every 10 seconds if you wanted to, are all things that probably don't help the long-term approach. Probably helps your world a lot, but doesn't help the long-term investment approach. And so there is a lot of awesome solutions out there. And, we try to be honest and agnostic and say, look, obviously we think we have some great solutions, but there's plenty of other great shops, Schwab, Vanguard, et cetera, BlackRock, that you can invest in a couple of these funds, not look at them again for 10, 20, 30 years and be just fine. The beauty of these, what people call these digital advisors or robo-advisors now, and There's a handful of them in the US to where they'll give you take a questionnaire, they give you a portfolio of, say, a dozen funds, they rebalance them for you, they tax manage them for you, you do literally nothing. And so to the person that wants a good solution and needs to spend, 10 minutes a year, if at all, it's never been a better time. And we can get into some specifics on how some of these are better than others and how some are still terrible. I mean, the bad news is that most of the investment world for even this long-term holdings still charge huge fees and can be very predatory. So if someone doesn't know what they're doing, you can still go down the route that our parents and grandparents do. But the good news is that most of all the news flow and fund flows demonstrate that it's kind of a one-way street. Most people don't go from a high fee, tax inefficient product where someone isn't a fiduciary to someone who by law has to be in your best interest, low cost funds that are tax efficient and perform well. Usually that's a one-way street, and usually it's a generational process that people they'll sell off their funds when they die or get divorced or inherit the money. I mean, there's a stat in the US that the average financial advisor that's been in business for, I forget, it's either 10 or 20 years, owns 200 mutual funds for his clients. And that harkens back to the days of, these salespeople showing up and selling a fund and getting a 3% commission and the fund costing 2% a year plus 12B1 fees plus a front end load. Well, that world doesn't really exist. I mean, it still exists, but it's dying a very, very quick death. So the good news is it's a wonderful time to be an investor, and you have never had better access to low cost products. And I'll even give you one more stat that a lot of people don't know. So for example, let's say you have an ETF, exchange traded fund, that charges 30 basis points per year. And so 1/3%. So it's super low already. Many of these funds actually will go and lend out some of the securities to short sellers on margin, and then they will return the short lending revenue to the fund shareholders. So there are a handful of funds out there that actually have a negative expense ratio, meaning they're paying you to own the fund. And that's a pretty cool thing, right? If you think about it, what a time we live in to be able to own an investment portfolio where the management fee is actually negative.
So you're talking about some of these robo-advisors which are becoming increasingly popular. If someone was willing to put in a little more effort, you said if you go down that path, you could spend 10 minutes a year to manage your longer term investments. If someone was to put in a little more effort than that, what's their chances of achieving better performance over the long term?
So this is an interesting question because to me, the beauty of a lot of the funds and strategies now is that if you go back to the 70s, when John Bogle invented the index fund, that used to have a certain meaning. That meant market cap weighting, low turnover, low cost. And that's what an index fund was. So something like the S&P 500, right? Well, it's that definition has been totally polluted over the years because active management used to mean is, hey, here's a manager who's trying to beat the S&P 500 and he charges 2% a year. And there's very little chance of him doing it, and it's tax inefficient. So that's why index funds have now grown so much. They're about, I think, a quarter or a third of the overall market. Well, however, all index funds have become at this point is rules-based process. So, for example, we were talking about how market cap index weighting S&P 500 is a good first step. But if you weight the stocks in the S&P 500 by almost any other methodology, you could equal weight them. You could weight them based on like a value metric, something like price to earnings ratio. People used to talk about dividend yield and the dogs of the Dow. So any of these weighting methodologies will beat the S&P 500 by 1% or 2% per year, going back as long as we have data to the 20s. The reason being is that market cap weighting has no tether to value. And so once you break this market cap link and you start to tilt towards value, so buying a stock that has a lower PE ratio or a higher dividend yield, you end up outperforming the S&P 500. Well, the good news is you can now get those rules-based objective portfolios for also very low cost. So you have indexes that are what people would have used to have called active management, but that are low cost, tax efficient for super low cost. So that doesn't necessarily require you to put any additional effort, really only up front. So we talk about this in a white paper we published called the Trinity Portfolio. It's free online. We'll give you a link in the show notes. And we kind of go through this holistic process of how to build a portfolio. So we start out with the US 60-40, and then we expand to global 60-40. And by the way, adding global assets doesn't really increase your returns or reduce your risk that much. What it does do is it reduces the possible extreme scenarios. So if you put all your money in Greek bonds and stocks, for example, that would have shown to have had a very negative outcome over the past decade. On the flip side, if you put all your money in U.S. stocks, and bonds, you would have done much better. But a global gives you kind of the average. So you'll never be the best or the worst, which is good. The second thing you can add to the portfolio is some traditional real assets. So think about that as real estate investment trusts, commodities, things like energy related or gold, things like treasury inflation protected securities, so TIPS, because a lot of those help protect against inflation. In the 1970s, as an example, very poor period for traditional assets. So once you have that portfolio, and by the way, we kind of call that the global market portfolio, and that looks like as you just went out and bought the entire world. So if you just said, I'm going to buy with one ETF, and we actually have one that does this, I'm going to buy with one transaction the entire world. I get 30,000 securities around the world. I don't have to do anything. Okay, that's a good stop, okay? Now, next step, if you said, all right, I want to improve upon that because I think Meb said market cap investing isn't ideal. What can I do? Well, the next step is you start to tilt towards things that have historically worked. And the two things we talk a lot about that academics have written thousands of papers on and thousands of books is value and momentum. So if you tilt these stock indices away from market cap to value and these indices towards momentum, those are both things that will increase the risk-adjusted return as well as the absolute return of that portfolio. So that doesn't really require any effort. Once you select the funds, you don't have to do anything because they rebalance themselves once a quarter. So all you have to do is simply monitor and rebalance it maybe once a year, even every couple of years. Now, the biggest departure I have from almost every other investment manager in the country. So if you look at all these robo-advisors, and we've done posts on this, I sound like a broken clock, but we'll give you show notes where we compare Vanguard and Schwab and Goldman Sachs and Wealthfront and Betterment. And they basically all do the same thing, which is give you that portfolio I just mentioned. The global market portfolio, stocks, bonds, a little bit of real asset. And that's a great thing. That's better than probably what 90% of people have out there. Now, the departure that I have is that it doesn't include an investing approach called trend following, which you've probably talked about on this podcast before, which I think for me personally is an investment strategy that I believe can give a more stable and consistent investment returns, as well as having the potential benefit of not sitting through long bear markets. But I think either approach is actually great. And the conclusion of this paper was, if you had to put a gun to my head, desert island, which portfolio would I pick? I would certainly pick the trend following portfolio, but it has its own challenges. So buy and hold, the biggest problem with buy and hold global portfolio is the long bear markets and drawdowns. 2008, right? So when everything's hitting the fan, people panic and sell. A problem with a active trend following portfolio is not necessarily in 08, because usually those do well in that sort of environment, but actually it's in the years that follow where you look different, where you do poorly in a year when everyone else is doing well. When your neighbors are getting rich by buying Snapchat and everything else, and you may not be doing, as well. So we said in this paper, the conclusion was kind of to put the two ideas together, 50% each, to diversify not only your portfolio, but also your psychology. So there's a lot of ideas in there, but my point being is that, and we wrote a recent article about this called the Zero Budget Portfolio, the vast majority of listeners don't have a written investment plan. So if you're listening to this right now, raise your hand, be honest with yourself. Do you have a written investment plan? I'm guessing 1% do. And then second, have you shared it with your wife, daughter, father, neighbor to keep you accountable? And unlikely the answer is yes, because, and this is why this is so important, is because people, the emotional component with the long-term investing is usually by far the biggest problem. So it doesn't really matter what the investment portfolio is so much, but once you set it, you don't have to monitor that much. All you have to do is keep yourself away from yourself.
Okay, well, speak to us a little bit about that. So what sort of things would you want to include in an investment plan? Like, what would one look like? And just to take it one step further, I think this is also quite important, is actually talking about your investment goals. So how would you suggest thinking about investment goals? Because obviously for most people listening to this, a trader is trying to hit much larger returns than what you're going to achieve from, a slightly passive with a little bit of active investing. So yeah, what are your thoughts around that?
Let me, I'll get to that, but let me give one quick point to explain why this is so important to write it down. So there's an investment survey that goes back to the 80s called the American Association of Individual Investors. And they asked their investors, are you bullish, are you neutral, or are you bearish on the stock market? And so no surprise, you've had a very wide spectrum of responses going back to the 80s. But if you look at the historical results and you find that the highest bullish rating ever in the entire survey was in January of 2000. So the literal worst month to ever be investing in US stocks in the entire history of the survey was when people wanted to buy the most. And say, on a flip side, when was the highest bearish reading? It was in March of 2009. And you couldn't have made up a more awful response to that survey than what the reality was. But again, going back to the point of that's why people are human, you wanted to do the exact opposite of what all of those people did. And so if you don't have a written investment approach, then you're simply flying blind. And when January 2000 comes along, you're going to be excited about buying pets.com and CMGI because your neighbor and broker are, and they're making tons of money. And the same thing happens in March 2009. You're going to be panicking. You're not going to know what to do. And so there's a lot of elements that it can be included. And so there's a lot of different people out there with different goals. My mom, for example, perfectly happy to sit in CDs. She sleeps at night, and that's what we say is the most important. Do you have a sleep at night portfolio? So a lot of people, first step, do you have 50 grand in the bank or, 1 or 2 years of expenses that you can cover your investment, your lifestyle? And if you don't really need to be putting the rest at risk because these, as we mentioned, these markets can have large drawdowns. And so 2 would be to write down, hey, look, the robo-advisors do a good job of this. Traditional financial advisors do a good job of this. Traditionally, they charge about 1% a year. And so if you don't have an advisor, we think they can be worth their weight in gold if you don't feel like you can trust yourself. And a lot of people can't. But at the same time, that 1% cost is a very real cost. So if you don't need one, you shouldn't be paying it. And I forgot to comment on this. We can talk about this asset allocation cost in a minute. But writing it all down and coming up with all of the inputs that you may have, and financial advisors are great because they'll provide you with a plan if you've never crafted one. But it could also be as simple as, hey, look, I'm going to buy this diversified portfolio of ETFs and rebalance it every 5 years. And that's it. Like, that's a policy statement. But in your head, you have to have the ability to say, is this going to stay consistent if gold goes to 5,000 or if gold goes to 200? If stocks go up 80% or down 50%? Are these scenarios that, or am I just going to watch CNBC and, react emotionally? Because usually that's the kind of worst kind of way to go about it.
As we're talking about, these major drawdowns that obviously happen from time to time when you're a buy and hold investor, what do you suggest actually doing in those periods? Like, obviously, I know you mentioned before, you said it's a good idea to, one option is to be 50% invested in trend following strategies and 50% in buy and hold. So they kind of balance each other out. But when you're in, let's just go back to the prime example of 2008, the GFC. What would you suggest for buy and hold investors to do in periods like that? And maybe periods that aren't even as severe as that, but when you're in major drawdowns or downtrends, what can you do as a buy and hold investor? Is it best to just ride that out, or, how do you deal with that?
So there's a couple comments. So if you are a buy and hold investor and that's your policy portfolio, I'm going to buy and hold, I'm just going to go about it, and then you do nothing. And you accept that drawdowns are a natural part of life. Because here's the problem with drawdowns is that markets spend the vast majority of time in drawdowns. They only spend about, I think it's like 20% of the time at new highs. And there's only two states. It's either all-time high or drawdown. There's nothing in the middle. And the problem with drawdowns is it gets exponentially worse the more they go down, right? So people often talk about compounding being the eighth wonder of the world. Well, unfortunately, the opposite is true to the downside. So it gets asymmetrical, and the kink really happens around 10, 15%. So you lose 10%, you only need 12 to get back to even. You lose 20, you got to get 25 to get back to even. You lose 50, requires 100% to get back to even. And if you lose 75%, requires 300%, right? So it's much harder to come out of these drawdowns. And the problem is you never know how bad it's going to be. So yes, theoretically, if you knew that stocks were only going down 50% in the global financial crisis, you should have loaded the boat in stocks, right? But the challenge is that 50 could have become 80. Here's where valuation helps. And so we've written a book on this topic called Global Value. And the way that valuation helps is it acts as a fundamental anchor from which you can use common sense. So here's an example. We use a valuation indicator called the 10-year PE ratio. Robert Shiller popularized it in a late 90s paper and book called Irrational Exuberance. Then Alan Greenspan used the phrase in court testimony, which made it popular. But it goes back to something that Ben Graham was talking about 100 years ago, where you look at a PE ratio, you average it out over a number of years to help average out the business cycle. And so for the S&P, going back to 1900 or U.S. stocks, for example, that value has been around 17 over time. Now, it's been as low as 5, and it's been as high as 45 in the dot-com bubble. And not surprisingly, if you group stocks into buckets of valuation, so 0 to 10, 10 to 15, 15, 20, above 20, in each bucket, it goes a stair step. So when the market's the cheapest, so below P ratio of 10, future returns are very high, 10-year returns. And this isn't a market timing indicator for the next month or quarter, but this plays out over years. And then when markets are normal, you're going to get 10% returns. And then when markets are expensive, you're going to have very low returns. And this has worked very well over the past 120 years. And so where we are right now, so here's what's interesting. So you went back to 2000, trading at a value of 45. No rational person would say it makes sense to be paying 45 times earnings for the S&P 500. And it gives you that kind of common sense takeaway. Now, in March of 2009, it got that what we call the CAPE ratio got down to a value, I think, of around 13. So really cheap. Not extremely cheap, but really cheap. And then where do we sit today? U.S. stocks have been the number one performing stock market in the world since 2009, which is very rare. Usually, U.S. versus foreign stocks is a coin flip. It's literally 50-50 as long back as we have data, which outperforms. And so you've had this massive outperformance in U.S. stocks. So U.S. stocks now trade at a CAPE ratio of 30, which is one of the highest values we've ever seen. It doesn't mean it's a bubble. I don't think the bubble really until you get into the high 30s or 40s. And it doesn't mean they have to crash. It just means future expected returns are going to be lower. So going back to the expectations and ideas we were talking about earlier, historically people have been expecting 10% for stocks. We think that value going forward for the next 10 years is probably around 4. And then you add on U.S. bonds at, say, 2.2 or 2.5, and there's no way that 60-40 portfolio is going to have the expected returns historically of what most pension funds and endowments expect of 8%. And so one of the things that people need to realize if you're looking into those assets is expectations need to be a lot lower. Now, the good news is the rest of the world ranges from reasonably cheap. So we were the first people to do this, but a lot of others do it now, where we built CAPE ratios for every country in the world. And so foreign developed sits around that 16 range, which is totally normal. Foreign emerging is down around that 13 or 14 range, which is quite cheap. And the cheapest quartile of stocks, so the 12 of the 45 cheapest countries in the world, is at a P ratio of around 10. And that's one of the biggest discrepancies between U.S. stocks and the foreign markets, particularly the really cheap stuff, in the entire history of the database that we have, certainly going back to the 80s and 70s. And thinking about stock opportunities, a long-term investor, you could either A, allocate to a fund that does this. So you could allocate to a fund that naturally rebalances into the cheapest countries, and we have funds that do that. Or B, when you're reviewing your portfolio on a yearly basis, take a step back and say, okay, and remarking about in the U.S., we were talking about earlier, where U.S. investors put 70% in the U.S. We say, you know what, maybe it doesn't make sense to be putting the most in, we calculate the second most expensive country in the world currently. Maybe we should be paring down U.S. stocks and allocating to foreign stocks, and particularly the really cheap stuff. And the interesting part about this is it's not always the U.S. The U.S. used to be one of the cheapest countries in the world when it hit a value of 5, and it could certainly go higher. It could hit a value of 45, and even higher than that, Japan hit the highest value we've ever seen in the 80s when it hit a P ratio of almost 100. But then Japan had terrible market returns for the next 20 years in what people call the lost decades. And it's not like Japan was some backwater economy. Japan's market got to be the largest by market cap as a percent of the world back in the 80s when it got to almost half. So if you're a global market cap investor, you had a minus 2% per year drag on returns because of investing in Japan during that period. So thinking about value and starting to tilt away from what common sense would dictate, and particularly in the U.S. right now, also applies to traders and short-term traders and traders working at banks, because many of them have additional exposure through their retirement plans or through their job, et cetera. But that's an easy indication, we think, that helps improve upon just the base case portfolios.
Now, just so we don't lose anyone, when you're talking about the CAPE ratio, what exactly is that referring to, and how is that different to a PE ratio?
So the CAPE ratio is a PE ratio. PE ratio is simply price to earnings ratio. And the CAPE ratio is, say, let's take a 10-year average of the PE ratio. So, and it also adjusts for inflation. So trying to compare apples to oranges over time doesn't make sense. So adjusting for inflation makes a lot of sense. And historically, we've done a lot of simulations with various P ratios, and the worst one to use is the 1-year P ratio, usually because it's so volatile. But the longer term metrics, whether it's 5 years, 7 years, or 10 years, work a lot better because they reduce turnover as well as have a longer term focus.
Okay. Now, I think this next question probably leads on from your last comments there. Let's talk about timing, like timing when to begin investing. Like, there's a lot of talk going around at the moment, as there always is. There's many people think the stock market's about to fall out of bed and all the rest of it. I'm not saying that it is or isn't. I really have no opinion on it. But there are people who do have the opinion that, we're going to see some severe downside. How do you time getting into investing? Because, if you'd bought any time in 2007, obviously 2008 would be very tragic. You've had to wait many, many years to get your money back and to even start making some returns. So how do you time getting into investing? I know that wasn't very well worded, but I think you know what I'm getting at.
Yeah, we deal with this question a lot with individual investors that are asking the same question, Meb, when do I get in? And should I jump all in, or should I spread it out? Should I wait? And my first response is always, look, a global portfolio, you're not just investing in one asset class. You're investing in U.S. stocks, foreign stocks, U.S. bonds, foreign bonds, real estate, commodities, everything in between. So there's a huge portfolio of different assets. However, even if you were investing in just one asset class and say U.S. stocks, the correct mathematical choice is to invest all of it now. Now, that may not be the correct emotional choice. A lot of people have a big problem with regret and hindsight bias. So if you were to invest it all in 2007 and the market crapped out in 2008, a lot of people emotionally and psychologically would have really struggled with that decision. They would have pulled their hair out and said, man, that was really dumb. I wish I hadn't done that. I should have waited a year. That was stupid. So we say, even if it's irrational, we're totally fine with people spreading out dollar cost averaging into their investments into as long of a time frame as they feel comfortable. They can invest every month for the next 5-10 years if they wanted to. And that traditional dollar cost averaging is a great way to go about it. But in general, the correct math is everything now. However, if you were to ask that question as a specific market, like we were just talking about US stocks and valuation, and say, look, the way that we liken it is it's like playing blackjack. And so you have a stock market that's trading at a PU CAPE ratio of 30, so very high historically. It's kind of like sitting down at a blackjack table and watching someone have a 16 versus the dealer's 10 up card. And historically, that's a hand you're very likely to lose. It's not guaranteed, but you're likely to lose. And the flip side, let's say you have a 19 and the dealer's showing a 6. Chances are you may win that. Chances are you should win that hand. Okay, so it's the same thing with valuation, where we're trading at a P ratio of 30. Chances are returns are going to be low. Could they go higher? Absolutely. But is the more likely scenario that they go down or sideways? Probably. And so in a scenario where you take a common sense approach, and if you were only investing in one asset class, you could say, look, like an expensive U.S. stock market, you could say, okay, I'm going to invest, but here's the rules. You know, I'm going to dollar cost and average until this gets back to an average valuation, et cetera. Granted, I think the better way to do it is invest in a global portfolio, start all now, because one of the things we learn from compounding is the earlier you start, the better, and make time work for you.
Sure. Yeah. Fair comment. I also want to go back to a comment you made a little earlier. You brought up rebalancing, and that's something we haven't really talked about too much, I don't think, unless it's sort of slipped past me. But how do you think about rebalancing? And just to bring it right back to basics, what's the point of rebalancing your portfolio?
So let's say you have a portfolio that's 60% stocks, 40% bonds, and stocks have a monster year, and they start to drift to where now your portfolio is 80% stocks and 20% bonds. Well, that may give you an exposure that has drifted from your original intended portfolio. And if given a long enough time horizon, those two assets, because stocks historically have had a much longer, a much higher return, you know, that portfolio is going to eventually end up being 90% stocks or 95% stocks and 5% bonds. That having been said, there's been periods of 20, 40, 60 years where stocks don't outperform bonds. But in general, the evidence has been stocks, Jeremy Siegel's famous phrase, stocks for the long run, stocks have outperformed bonds. Now, the more assets you have, the less it matters. So what we often say is rebalancing is good to do as long as you do it sometime. So even on a yearly basis, you rebalance to target. It gives you the nice discipline of selling the winners, adding more to the losers, and rebalancing back to target. However, in a multi-asset class portfolio, you could do that every even 3 to 5 years, and it's not going to make a difference. It only matters that you do it sometime. So if you left it for 20 years, then it gets kind of out of whack. So really rebalancing, I think, is, and the biggest consideration is to do it, make sure you do it tax efficiently. So you're doing it to where you're not paying a lot of taxes and doing it smart, but it doesn't matter that much as long as so the true lazy man, these global asset allocation portfolios can be very lazy. You could buy into one and not do anything for 5 years if you wanted to. But we often say yearly because it's just a nice habit to say, hey, I'm going to look at my investment portfolio once a year, make some tweaks, and that's about it.
Okay. Now you brought up tax considerations and doing it in a tax efficient way. I mean, I know everyone's tax situation is different, and I mean, we've got people listening to this podcast in however many different countries. Just broadly speaking, is there anything you can add around the idea of doing things tax efficiently?
Oh boy, there's a lot. And let me sort of, I'm going to talk about taxes, and then I want to talk about fees too, because if everyone listening hasn't fallen asleep yet, they're probably going to nod off now. But the irony is they're probably the most important determinants of your future performance of your portfolio, vastly more important than your asset allocation for long-term investors. And let me explain why. So taxes, if you look at traditional investment options, so let's compare an index fund to a actively managed mutual fund to a hedge fund, right? And so let's say that we're targeting a return net of all expenses of around 8%. Well, the index fund, you only need to have about a 10% return to have a net of 8% return after all taxes and fees, because likely the transaction costs are low because the fund doesn't have much turnover. The management fee is only 0.1%, and you're not paying a whole lot on taxes and dividends because it's a fairly tax efficient portfolio. Still pay it on dividends, but not on taxes. So you really only need a 10% return to get to that 8%. An actively managed mutual fund, because it probably has 100% turnover, and because the management fee is that traditional 1.25% that we talked about earlier for mutual funds, you all of a sudden need to have over 13% gross returns to get that 8% after tax. So that mutual fund manager, and this is why the high percent of mutual funds fail to beat the indices, is because of the high turnover and the high annual fees and costs. And then lastly, you have our hedge fund friends, which charge 2 and 20 and have probably even higher turnover. You need to generate a 19% gross return to get to an 8% net return. And that's one of the biggest problems with a lot of hedge funds. People see them as being very sexy, the high returns potential. Here's the great stuff they're buying, very swashbuckling. But the problem is, particularly in taxable accounts, you really want to avoid them in many cases because they have to generate a massive amount of alpha just to break even with an index fund. So that's just kind of illustrate the importance of taxes. And there's a lot of other things you can do, say, try to optimize where you hold the assets, whether in taxable or tax efficient accounts. We actually did a blog post, which we're not going to go down that rabbit hole because it's probably a whole nother hour-long topic, is talking about avoiding dividend yielding and yielding stocks in general in taxable accounts because they underperform once you include tax on dividends. But the one segue that I wanted to make that I think I should have mentioned earlier that I think is profoundly interesting is in our book, Global Asset Allocation, we look at, when we're talking about these asset allocation portfolios, we went around and said, this is interesting. There's been about a dozen super famous guru investors. So we're talking Dave Swinson of Yale, Warren Buffett, Mohamed El-Arian of PIMCO and Harvard, Ray Dalio runs the largest hedge fund in the world. These guys that manage trillions that at one point have stated, here's a recommended asset allocation portfolio for an individual investor. And so in the book, we said, okay, well, let's examine how all these portfolios have performed all the way back to 1972. And they are vastly different portfolios. Some put 25% in gold, some put 0, some put 50% in stocks, some much lower amount. And so these portfolios look very, very different. With the exception of the permanent portfolio, which isn't really fair because it has half the portfolio in cash and bonds. These portfolios, all dozen of them since 1972, performed within 1 percentage point of each other. And to me, that is an astounding statistic. And so here's the fun experiment. If you went back to 1972, and I said, Aaron, I'm going to give you a crystal ball. I'm going to let you pick the single best asset allocation portfolio out of my book for the next, 35 years. How much would somebody pay for that? How much would PIMCO pay for that? Billions? Absolutely. I said, however, here's the catch. You have to implement that portfolio with the average mutual fund fee today, 1.25%. Let's not even talk about the average mutual fund fee 30 years ago, 2-3%, but 1.25% today. Would you take that deal? Everyone would probably say, absolutely. I get the best performing portfolio. So that would have been the El-Arian portfolio, which is endowment-like, so very heavy exposure to growth and equities. Had you implemented that portfolio with the average mutual fund fee, you would have transformed the best performing portfolio in my book to almost as bad as the worst. So the takeaway being that most people, what do they spend their time thinking about as long-term investors? Their asset allocation, are stocks expensive? What about gold? How much should I put in bonds? Should I be buying Greek debt right now? Is the real estate market, how's that going to do in a Fed rising environment? And what should I do about Bitcoin? All these questions that people spend all their time sweating and thinking about. How little do they think about fees? If you had to go a step further and said, you know what, I don't trust myself, so I'm going to hire an advisor, pay him 1%. He's going to allocate it to a great portfolio of mutual funds at 1.25%. That would have taken the best performing portfolio and made it far worse than the worst performing portfolio in the entire book. And that, for a lot of people, is a tough kind of pill to swallow. They want to think about the exciting parts about investing, which are, the stock market and everything else, but really the boring blocking and tackling of taxes and fees is likely going to have a much bigger impact on your portfolio than everything else we talked about over the past hour.
Right. Well, that really puts things in perspective.
Or puts people asleep, one or the other.
All right, Meb. Well, let's summarize some of the things we've been talking about over the past 60 minutes or so. So from what you've seen, where do most people struggle the most?
It's unquestionably with their emotions, and we see this over and over again, and it has different flavors, of course. But our Canadian friends who are flipping real estate houses right now are probably getting to see it, and they're having conferences where Pitbull is hyping people up about investing in real estate to, you see these sort of bubble. We've written papers on, one was called Learning to Love Investment Bubbles, and it goes back to the South Sea bubble in the 18th century and talks about all these famous bubbles across history. And you see them rinse and repeat over and over again. And I think the biggest challenge for people, one, is they don't teach, at least in the US, they don't teach personal finance or investing in high school. It's not a core curriculum. And for most people, they don't teach it in college, unless you're an economics or investment major. And so a lot of these concepts, what is probably the one skill set that every human being on the planet uses the most? And it's personal finance or investing, and how to just deal with money. And so the biggest challenge, I think, is coming up with an investment plan that's logical, that you can implement, that's based on history, and sticking to it. The biggest key being sticking to it, and not getting caught up in whatever the macro environment is, because the biggest challenge is that the times that you want to be investing the most is the times that it feels the hardest, and vice versa. And
just to take a step off that, investing can be as simple as you want to make it, or it can be as complex as you want to make it. Where do you see many people overly complicating things? Like, is there anything which stands out to you?
Yeah, we see a lot of people that come to us with portfolios, and we call this mutual fund salad, right? Where they show up and they say, here's my portfolio. I have 30 mutual funds. And you can't even ask them, say, what percent do you have in stocks? What are your exposures? They have no idea, because they've just been accumulating these, and the psychological bias have become wedding to something you own. You care more about it once you own it. So whether that's your car or your house or your stock portfolio. So we often tell people, say, look, it's okay to start from zero. You can sell everything, ignoring taxes. So if you've owned GE since the 1940s, ignore that last comment. But in general, you can sell everything and start over. And the biggest problem people have is, I think, often they pay way too much in fees. And this is even more onerous to your listeners in, say, Europe and in some countries around the world, to where indexing and low-cost pressure of like a Vanguard hasn't really caused the entire space to go down. But, I think that paying a lot in fees and become emotionally attached to your portfolio is a big one. And that's the beauty of a digital advisor. And I think you're going to see a lot more of this. And this is one of the reasons we're in the early innings of this sort of disruption, which is great for investors. And an example is this. So there's 4 ETFs that are asset allocation, global asset allocation ETFs, where we have one of them, that charge less than 0.3% per year. And they manage around $2 billion. So pretty good, right? But there's something like 600 mutual funds that charge over that amount. In some cases, it's 1%, 2%, 3% per year. They manage almost $1 trillion. And so you can see a lot of this money is still in very high fee structures and look, I'll be the first to admit, all that matters is total returns after all fees and taxes. So if you got a killer hedge fund doing something crazy that's making great returns, hey man, thumbs up. But the vast majority of managers that aren't doing anything, by definition, are meant to be lazy and buy and hold. You should be paying as little as possible. So simple takeaways, are the good news is a lot of the stuff to put into practice is very simple. So a long-term portfolio, have a plan, pay as little as you can in taxes and fees and stick to it. That's good advice that most people can handle. And the digital advisor, the beauty of it, whether you use ours, whether you use Vanguard's, doesn't matter, is that they do it all for you. And it kind of whirs in the background. And I think particularly the younger crowd listening can certainly identify more with that a little more than the older crowd, although the average age of our investors on the digital side is in the late 40s. So perhaps maybe it's not as true as we think. But anyway, it's a wonderful time to be an investor, and I would say just be mindful of what you pay and how you implement it.
Yeah. Well, Meb, this has been really interesting. If anyone listening to this podcast maybe has some questions or they want to find out more, where would you point them? Where's the best place to go to find out more about you?
We got about 4 places. So you can watch me pick fights on Twitter at Meb Faber. We have my blog, which has thousands of posts on it. And that's just mebfaber.com. We have my 3 work sites. So there's the digital advisor is CambriaInvestments.com. The fund website is CambriaFunds.com. Our research portal is theideafarm.com. And I think I mentioned it before, but if you want to download a free book, freebook.mebfaber.com. You get to download our last book off Amazon. But lastly, just shoot me an email. More than happy to connect anytime. And if you're in Los Angeles, come look me up. We'll grab a beer or a coffee.
Cool, man. Well, I'll make sure to include all those links in one place in the show notes at chatwithtraders.com as well. So one thing you didn't mention is you've got a podcast yourself. Where can people go to find out more about that? Is that on your blog, I presume?
Yeah, blog, iTunes, Meb Faber Show, creative name. But yeah, it's been a lot of fun. And we try, if I can get around to it, put out 1 per week. But as you know, Aaron, it's a labor of love and it's a lot of work. So you guys make sure to go give Aaron lots of good reviews because it's a lot more work than I thought it would be. But it's been a lot of fun.
Yeah. Admittedly, I was a little bit naive going into it as well. It turned out to be a bit more work than I expected, but no, I thoroughly enjoyed it. Meb, thank you very much for coming on the podcast, man. I truly appreciate it. Yeah, thank you once again.
Been great. Let's do it again.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.